So we're going to dive into kind of what's going on with the mortgage interest rate market. As you probably are hearing, interest rates have gone up and are continuing to go up, and that is true. But what does that even mean? What does that look like? And to what degree is that? So what we're looking at here is just a chart of what's called mortgage-backed securities, which is one of the indicators that we're going to be looking at to see what's going on in the mortgage market. And to really keep it simplified, but show you the impact of the volatility of this market, I want to show you this chart. So what you're looking at here is if you look at the first to the left-hand side, and you can see this goes back to January, you could see on this chart that we are at a higher level on the chart, meaning we're towards the top. What that means is that interest rates at this time were lower than where they are today. So when we're at the top part of the chart, interest rates are lower. When we're at the bottom of this chart, interest rates are higher. So you can see the move that it's had from January to today and where we are at the bottom of the chart, meaning that rates have gotten higher. But what does that mean? So if you look at this chart here, you can see a per day snapshot. So it will track every single day and let you know what happened from the previous day to today, how it closed out. So what you're going to see here is if it's red, that means the interest rates were worse that day than they were the day before. And if it's green, that means that they were better. So you can see there's huge volatility. Is why I like to show this chart, because you're seeing on here that there was some normalcy in the beginning of the year, not very much movement up and down, kind of normal. And then you can see some pretty big swings. So you can see here a big drop from January today, which had interest rates, from where they were to where they are now, 1.5, 2 points higher than where they were with the mortgage rate. And so you could see a lot of volatility in it. Now, based on what's going on right now in the economy with highest inflation that it's been in over 41 years, with where we are with what's going on with the war, where we are with what's going on with all the different Fed hikes and the interest rates, balance sheet runoffs, all of that, we are expecting, the top economists are anticipating that we're going to continue to see mortgage interest rates rise through the end of the year. So it can have a big impact for people that are looking to purchase, that need to sell and buy, that maybe are going through a divorce situation and have to do what's called an equity buyout. And so it does have an impact. So we want to look at, well, what does this mean short term and long term so that we can better prepare moving forward? Well, what it means is that we're heading into a recession. So if you look at all the indicators of where we are now with interest rates, and you look at some different factors and indicators that we're going to look over, you could see that we are heading to a recession. What is a recession? Well, recession simply means that the GDP, which is what measures where people are spending money, is down for 2 quarters or more. So it means that now people are not able to, or they're not putting money back into the economy. And so now it's creating a recession. How does that mean for mortgage and real estate, though? Well, for mortgage and real estate, as you can see here, there's a couple indicators that show that we're moving into the recession, and one of them is unemployment rate. So if you look here, this tracks all the way back to the 50s of where unemployment rate levels were, and then were recessions. So you can see this dark line here that shows recessions, and you can see the unemployment record here. So this is one of the indicators that shows that, yes, we are heading to a recession, because as you could see, when unemployment goes up and then it comes back down, well, then we hit a recession. Goes up, comes back down, well, then we hit a recession. So you can see here that unemployment had went up, and then now it's come down to a great low, which is great that those numbers are there. But when we start seeing it trickle back up, which is kind of what we're starting to see, if you look at different numbers, we are still at a low, but we are going to see that continues, or that starts to shift, as people are going to have to start laying off people because they need to hold more of their earnings in the business companies because things are more expensive. And when that happens, then it's a trickle down effect to where people are being laid off. Well, now those people that are laid off are spending less, which is less money. And when there's less money, it continues the cycle. So when we see that unemployment rates are low, when that starts to tickle back up, which we're seeing some indicators, is when we hit recession. But what does that mean to housing and mortgage? Well, as you can see here, if you look at the housing stays strong through recession, if you look at this house price index, you can see here that all the way back from the 60s, every time we hit a recession, which is the dark line that you're seeing here, housing continued to rise. So housing stays stable through recessions. The only time that we saw a dip was back during the crash, which was, caused by oversupply and bad loans. We don't have oversupply. We have undersupply. There's not enough inventory. We are at the lowest point of inventory that we've been in a long time, especially with builders not being able to build out enough and not having enough inventory to turn over. So as you can see here, with all of these recessions, housing continues to stable. So what can you do to protect your wealth in this market? Well, create a family budget. Step one. So as a mortgage advisor, I'm very passionate about financial education and literacy. I've created a lot of courses and programs to help my clients be in a better position. So you want to create a financial budget. If you don't have one, then I highly encourage you to take my course. You go through the six steps to create financial freedom and wealth, and it'll show you the basic things that you need to do to be in a better position, to take control of your life. You can be in a better position if you do the work and you follow the course and you look at the information. Consolidate your debt and save, just like we went over, whatever position. And maybe you don't have that much debt, and maybe you have a 401k that you could take a temporary loan from that has better terms than your credit cards. And you can take that 401k loan, pay off all your debts, keep your credit cards open, don't close them, it will hurt your credit, but pay off your debt. And then you have your 401k loan that you could start paying what you were paying towards your 401k and get it paid off sooner, maybe because your interest rates are lower than they will be on credit cards. Because as the Feds increase rates, look at your credit card statements. Those are going up and they're going to continue to go up. We've got to take charge, and we've got to get into a position to where we can lower the interest into a fixed interest to where we have a plan to get them paid off sooner, so you're not just paying minimum. So you want to consolidate your debts and save. Then you want to create and implement a financial plan. Again, it starts with the family budget, but then you're going to go through an entire financial plan of where do you want to be? What's your plan to retire? Do you want to save for your kids' college fund? What's your savings plan look like? Do you have an emergency fund? All of these are very important things that we need to know and understand to make sure that we're in a good position in any type of market so that we're not in a bad position moving forward. So you can give me a call. Let's look and see if we can utilize your mortgage to consolidate debts based on what we just went over and see if it makes sense, or maybe come up with some other alternatives. Maybe it doesn't make sense, and I will be happy to tell you it doesn't make sense, but we want to look at all options. Then take control of your finances. So you can start with the course. I'm going to go ahead and give you access to it. You can see here, and it has the password so that you can go in and you can follow the course. The biggest thing is that you really need to commit. If you're in a position that you're not happy with your finances, you're not happy with your wealth, then I encourage you to make time. Put this on your calendar. If you watch this and you don't do anything with it and you're in a position that you don't want to be, it's going to stay the same. You got to take the action, and you got to have the discipline to do the work. Put this on your calendar. It's 6 short videos that help you get the education, the resource. It even provides the tools and the resources within it so that you can be in a better position. So if nothing else, create your family budget, watch the family financial plan and wealth so that you have the information to be empowered. My goal is to give you the information and resources to make good decisions with your money. If you have any specific questions, please reach out. I want to be of service to you. I want to be able to help. My goal is to help our community be better with money, create generational wealth, and be in a better position so that we don't have to live stressed from money, which most people and most Americans are today.